Hey everybody, this is Jose Blasco. We are about to start the session. This is a sound check as always. We are 1 minute away from start. I would appreciate a quick message on the chat box, just with a quick hello. That would tell me that you hear me and that would tell me that sound is good. So we are ready to get started. Please go ahead and share a quick hello on the chat box. So I know we are ready. We got 30 plus seconds to go. So let's do that. Thank you so much. Okay, 15 seconds to go. I'm turning on the video stream so I can say hi from my corner. How are you, my friends? Good to see you all. And yeah, 5 seconds to go. I can see sound is good. I got the confirmations. Thank you, guys. Thank you so much, everybody. So let's begin. Welcome to the session, everyone. Today is December 22nd, 2021. My name is Jose Blasco. Today we are going over options trading. The name of the session is Options with Options, so the name says it all, isn't it? And the plan today is to analyze the markets, identify market opportunities, put the trades in place, which means we need to do market analysis. We need to review all the rules of our methodologies, make sure they are met before we execute. Okay, that's the plan. So I am highlighting the disclaimer on the upper left side of the screen. Please read it carefully. This is important information. Do not skip it. Read it completely so we are in the same page. Thank you so much. How are you, Christian? It's good to see you. And finally, as we're starting the session, the agenda, we're going to be looking at the current market environment. Then we're going to review trades that we have. And from there, we'll move into trade execution and look for new opportunities, which ideally, this is where we spend the greatest amount of time, even though just to set the right expectation on the Wednesdays, sometimes we end up spending more time on the trade management than on the trade execution, given the fact that we haven't met since the last Thursday, isn't it? We don't have too many trades today, so I would think that we should go quite quickly. Good. As we begin the session as well, I wanted to mention the URL tradewithufos.com/Jose, or any of your coaches, could be Becky, Boyan, Pedro, Reynaldo, you name it. Any of your coaches, you can use their name here at the end. And what this would do is bring you to this page where you have a question and answer section where you can log in by clicking on the purple button, ask questions by clicking on the green button, and then here you got plenty of prior questions with their answers. So you can actually, before you post a question, you can actually search, and maybe your answer is already there waiting for you because another trader, another member of our community has asked the same question before. Okay, cool. Okay, so with all of this said, we are ready now to jump into the market. Here is top. So we are now looking at the S&P 500 ETF, SPY, and we're going to begin our market analysis. Okay, so what is it that we see? Well, the first thing that we see is that we are in a current blue climate. Okay, we are in a current climate. The climate is confirmed. So we are in an up climate. Statistics suggest that being a buyer carries statistical advantages. This is candle number 1 out of what an up climate would be 6. So we are just starting an up climate, and therefore a perfect time to actually run a session. Ideally, we're going to find opportunities and profit from that potentially developing climate from 1 to 6 and profit from that. We're just coming from a red climate where statistics suggested it will last for 2 candles. It's not always like that. Notice how the prior red climate lasted much longer. But in this case, it was a short, I mean, not a short, it was just a climate duration that did meet what statistics suggested, which is 2 candles. Okay, so in that sense, all is good. And again, green light to go ahead and start being a bit more aggressive with positive deltas in this case, which, in prior cases, we were discussing how the climate was blue here, but we were not too positive when it comes to being aggressive with positive deltas. And the reason why is because when looking down, the gray line that represents the implied volatility of the puts, so that gray line was above the implied volatility of the calls. Okay, and you can see how that was impactful because look at what happened next, right? So it was a pretty strong drop in price from 470 plus to around 450. That was interesting. Okay, not the end of the world. It was a normal down climate, but we kind of saw it coming thanks to looking at options data. What we see today is number one, implied volatility for the calls and the puts to be equal. So in that sense, we don't have a clear advantage either to be bullish or to be bearish, but at least we don't have a disadvantage. And the climate is confirmed and just starting, right? The other thing that we can see here when looking at volume map is that today, real time, because here what I have here is the 3-day average of the implied volatility for calls and puts separately. Well, here I have real time implied volatility, and notice that real time is also equal. So there is a little bit of a battle, but while there is a little bit of a battle going on, you can see how 2.9 times more calls have been traded versus puts, 2.3 times more, 2.01, 2.1, 1.3, right? And you can see how the call volume is surpassing the average, where the put volume is not surpassing the average in the next expiration date, which expires on the 27th. So in other words, it's looking like bullishness is kicking in big time. Okay, big time. And we saw actually on that candle at this moment in time, okay, we saw that the implied volatility of the calls was above the implied volatility of the puts for the first time, and from there, look at what happened, which is a pretty powerful move. Okay, so again, right now calls and puts are kind of equal. There is a little bit of a bias towards the call side, especially being above the average volume. But again, most importantly, the climate is blue and confirmed, and we are beginning a new climate. So again, when looking for trading opportunities today, my plan will be to look for longs. Okay, that will be my priority, and depending on the amount of time left, we'll look at other trades as well. Now, my only little concern there, and it's just because as traders we always need to manage risk, and that's why I'm using the term concern. My only concern is that we got 3 UFOs here overhead. Price is now entering the first UFO. Okay, so you would expect price to correct and retrace a little bit, which to be honest is going to be great for us because we'd want to see the price to come back down towards the average for them to take off again. We'd love to see that, like for example here. Okay, price came back to the average and then it goes. So we'd love to see something like that. But the only problem I have is that so far, okay, and this may change in a few minutes from now because AutoUFOs is looking at the markets real time. So anytime we may have some green UFO that shows up somewhere here, and then I wouldn't have the concern I'm about to phrase. But my only little concern there is that we don't have any UFO all the way to 458. So the consequence of what I'm saying is that if those UFOs above were to push the price down, there may be a chance for price to have to come back all the way down to 458 before it keeps going. So that's the only issue. Okay, so we're gonna be looking at the setups of those potential long opportunities that we're gonna look for, and we'll try to be a bit on the conservative side, just a bit, slightly on the conservative side because of that. If we had a green UFO here, then I'd be happy to be more aggressive. But without that UFO, we'll talk about being a bit more conservative later on. Okay, but again, conservative, quote conservative, because again, we have a beginning part of a climate, and there is not too much risk overhead like we had in the prior 2 weeks, isn't it? Which led to this sideways market, basically. Right now, the way the market is looking like, it's more like it's going to be a breakout, and we're going to start making all times high again. Cool. So that's my analysis for the market. If you have any question, this would be a great time for you to phrase it. If you have any comment, any different opinion, any other way to think of the values that you get from climate or any other tool that we use, feel free to comment on the chat box, and let's make this as much as we can a conversation. Instead of just my opinion. Okay, so in any case, I'm happy to lead, but if you have anything to say and it doesn't coincide with what I said, it's okay for you to phrase it. Okay, we are here to discuss, guys. COF, I'm looking at the positions that we have. So COF, I got 3 positions. If I look at TOS, there we go. So we have 3 positions: COF, Starbucks, and Yelp. So when looking at COF, let me look at that on the chart. So COF was a bit disappointing in the prior days, okay, with a pretty intense drop down. Okay, so again, notice this long candle going down, right? So pretty intense drop down, but now it's moving up, pretty strongly as well. So again, that's good. Having said that, a red UFO just showed up, and the probability of that UFO to bring price down to 134 is 60%. So I would not expect this to just keep going and going and going, okay, anytime soon, okay? And that's why we converted this position into a butterfly. So in that butterfly scenario, if I look at the midpoint, so we are netting a theoretical midpoint price or PNL of $59. The red UFO is gone. On the 2-day time frame, Christian? Oh, for SPY, got it. Okay, let me take a look at SPY. Yes, well said. Okay, so those on-field orders has been cancelled, which again, it's to be expected too, because in an up climate, sell on-field orders tend to be cancelled and buy on-field orders tend to be added. But I want to see those buy on-field orders being added. Okay, I want to see that, and so far I don't see them. Therefore, not as happy as I would like to be, even though it's not too bad either. Okay, especially now with the red UFO gone. So coming back to COF, again, we butterflied this trade, and therefore we are in that position. I'm just gonna graph it so we get to see it. Sorry, not the option chain. I just clicked on the risk graph. That's what I wanted. So I'm just gonna graph it, and when we graph it, so you can see we are currently here. So it looks like no matter if the stock goes down or up, in the end, it's looking like we're gonna make the maximum profit that this trade can make, which is $58. Okay, so we are there. We cannot lose on this trade, but if that stock was to rally and was to rally all the way to 179.4, so we could actually make around $500. So that would be great. It would be great to see. It's looking quite unlikely, but again, remember, COF belongs to a strong industry, and while right now is not behaving too well in our favor, we've seen that before. The next thing you know, those stocks pick up speed big time, and next thing you know, we are reaching the target. Okay, so we'll be talking about this all the way to January 21st, because that's when the expiration date of this options contract will reach expiration. Okay, Yelp is another trade that is not working too well. So if I was to compress a little bit the chart, so this crossover here is when we entered into this trade, and that was a trade that we're planning to profit to the long side, but it went all the way against, and now he's doing his thing. So we are indeed underwater, but again, another case where we went from a spread into a butterfly, and again, we are containing the risk of the trade while we're giving the trade a second chance. So we are applying our classical damage control mode. Okay, and again, I don't have anything new to add to prior comments that we had on this trade. We are currently here. The net PNL is minus 80. Okay, worst case will be to lose 300. But if that stock rallies, okay, as long as now we are above 38 or something like that, which again is not too far, right? So now we're gonna start being in the profitable area, and ideally we'll reach 42 something, where we could make $490 per contract, something like that. So that would be great. Again, this is to be seen, because so far that stock did not behave in our favor. So we're just giving it a second chance, but not too much trust in it, isn't it? And finally, we got Starbucks, okay, which is a non-directional trade. So let's take a look at Starbucks. Starbucks is an Aaron Condor, is the last trade that we put together last week. Here we go. Okay, and okay, so we enter Starbucks at that very moment in time, right there. Okay, and what we need is Starbucks to remain in the purple area from now until Friday. Currently, Starbucks is trading here at 111.32. Uh, Probabilities suggest that on that date, we're going to be reaching that level, okay? Or that level, which kind of coincides with our entry. So it does look like, at least from a theoretical point of view, it looks like we are going to end up in the purple area, and therefore this trade would end up for a full profit. Again, remember, this is a 1 week iron condor, and one of the big lessons that we have learned, I believe it was with Facebook, if I'm not mistaken, with Meta, is that when you do a 1 week iron condor, basically you're either right, you're either wrong, but it's not like you have too many choices of things that you can do to massage the trade and try to improve it in case the stock moves against you. Why? Because you only have 1 week to expiration. Now it's only 2 days and a half to expiration. So you cannot do much. Even if you roll options, the extra premium you get is so tiny that sometimes it's not even worth it, which is what happened the other day, isn't it? So in this case, all is looking good. So far probabilities suggest that stock is going to be in the range, in the purple area. So there is not too much to be concerned about. But let me go back to here. So when you look at the P&L of Starbucks, we are making $12.5 if you were to close at the midpoint. When we took this trade, let me go ahead and go back to the positions and graph it. Should have done that before. So risk graph. So when I did this trade, the maximum profit here is 20, meaning that I took 20 cents of credit. Okay. So remember that one of the management techniques that we talked about that you could implement was to close the iron condor for half of the credit anytime that's possible. So half of the credit is 10, and that means you will make $10, where currently it seems that if you close it, you're going to make 13. So for the ones of you that you don't want to stay there, and you are very active and you want to use that particular option I mentioned the other day, so you could go ahead and close it. Okay, you could close the trade and that's it. In my case, I'm not going to close it because statistics suggest we're still going to be in the purple area, and I would like to save myself 4 commissions and make a little bit more of a profit, especially when you are dealing with an iron condor that provides such little amount of premium, 20 cents, which again was meeting our rules. That's why we took it. But if it's only 20 cents, probably means that you took the trade with many contracts to have a decent profit. And if you're gonna have to close it now and pay 4 commissions per amount of times you did the trade, so you may end up paying, I'll go as far as saying too much of commissions, right? And fair enough, but that would certainly hurt the P&L of the trade. So in my case, when I do trades of this sort, I'm totally open to get my full loss, which I know in an iron condo, which lasts for more than a week, I can always massage my trade and reduce my full loss to be less. In this case, I won't be able to do it. But that's the trade-off. That's the price to pay to not to close the trade now, which I prefer. But again, if you don't prefer and you want to close it now, so this is a time where now you can exit this trade for around half of the premium you collected, and that is indeed a valid trade management rule. So keep that in mind. And we'll revisit this trade tomorrow, and again, if everything works according to plan, according to statistics, we should be okay. Christian, how will you use a Bull Harami on the weekly time frame to establish long-term ETF positions? Great question. Since we are talking about getting bullish, actually, maybe we can approach it from that angle. Example, IWM today, unrelated topic, but I am curious. Yes, absolutely. So, yeah, you know what? Let's talk about that, Christian, okay? Because I'm done with the review of the trades. So let's go ahead and begin. Let's go ahead and begin planning on the trades. So again, the normal way on how I would start planning for trades, it's go for the matrix. And because I said that given what's happening on the S&P, etc., I was going to be bullish and look for positive deltas. So, I would be looking for advanced option scan. I would be looking for top positive CIV spread, isn't it? I would also be looking for cheap options, right? I would be looking for, options that are mean less than 20. So I would start like that. Then I will look at my stock filters, etc., right? But let me pause here. Let me come back to this later, okay? But right now, let's talk about Christian's question, which is, okay, so I want to be bullish, but it's not only for a few day trade. I'm looking at it more as a long term thing, and I want to do it with ETFs instead of doing it with regular stocks. So what can you do? Okay, well, and also you are looking at bullish haramis. Okay, so one thing you could do is in the weekly bullish candlesticks. Okay, you can be looking at bullish haramis. Okay, instead of US stocks, instead of stocks, you can use ETFs. Okay. For now, because there are not that many ETFs, I'm just gonna take off the option of cheap options. So we'll come back to this later. Okay. And for sure, I would like the ETF I select to belong to a grouping which is strong. So again, you could, if you choose ETFs such as IWM, so then you don't need to link yourself to grouping, but some of the ETFs may be more related to certain industries. So it could certainly be a good idea to make sure that those ETFs are going to be strong. So one way to do it is, you can double check, because not all ETFs are going to represent the industries exactly. So you can check that the stock in this case is going to be an ETF, because I selected ETF, is going to be strong, and I'm selecting long term because you are looking for long term opportunities, and also long term for the grouping, which again, the grouping will be looking into the industries as defined by top instead of the holdings as defined by the ETF company. Okay. Then scan list, again, because there are not that many ETFs, I'm just going to leave it empty in this case. The strengths, I'm going to leave it alone. Earnings, I can also uncheck because there is no earnings on ETFs. And then finally for auto climate, okay. So because I'm looking at long term, so I will be looking at the weekly, and ideally I will want it to be weekly up and early, and ideally close to the near EMA. Okay. Now all of this is very demanding, especially if I'm dealing with stocks only, with ETFs only, which there are, let's say, a bunch of, there are many, actually, it's a few hundreds, but compared to 1,000 stocks, is very little amount. So probably when I click scan, I may not have results, or maybe very few. Okay, so let's take a look at what we have. Okay, and that's what I was expecting. So I will probably need to start on checking some of these things to see if I end up having some opportunity. Okay, so instead of early, I'm going to be looking at sensible. Okay, and even with sensible, so I'm not getting anything, which probably tells me that, when I was looking at the grouping of the rotation, strength and rotation and so on, it's probably creating a little bit of an issue there. Okay, so did you say? Okay, yeah, on a long term, right? So let me uncheck auto climate, because so far I get nothing. Yeah, I get nothing at all. So it's looking like, let me make sure I don't have anything check mark by mistake. Yeah, everything is unchecked. And right now, when I look for bullish haramis on ETFs, I got nothing. If I look at bullish harami on stocks, I got nothing either. Okay. Okay. Yeah. So it seems that there is no bullish haramis. That's the problem. What if we look at it in a daily time frame? So bullish haramis on a daily time frame. So now we start seeing something. Okay, now we start seeing something, but not too many. Okay, so I'm curious to see IWM, because maybe. Okay, just 1 second. I will explain what I mean in a moment. So you were looking at the weekly time frame. Oh, okay, got you. So you are calling a bullish harami what you see on the screen right now, but top doesn't call it a bullish harami until the candle closes. Okay, so you will need to wait for the closing of the week, which is Friday, for top to call it a bullish harami. Technically speaking, a candlestick pattern is not a pattern unless the candle closes, and because it's a weekly time frame and we are still during the week, then that's not a harami yet. Okay, but I do see it's a harami, but but not yet. Does that make sense? Got you. Okay. Actually, let me rephrase that. It's not a harami, it's an engulfing candle. So the new candle is engulfing the prior one. Harami would be that the next candle, meaning the current candle, is fits within the prior candle body. Okay. Harami in Japanese means pregnant woman. So you may want to think about the current candle as a baby, and you may want to think about the body of the prior candle as the mom's belly. So the baby is inside the mom's belly, and that's why it's called a harami. Okay, so you will want to see a small candle, in the last position. In this case, you have a large candle in the last position, which is what is known as an engulfing candle. Okay, it's an engulfing. So, but anyway, the prior pattern, to be honest, is also a bullish pattern. Okay, so I'm pretty positive we should be able to find results if instead of scanning for bullish harami on the weekly time frame, we were to scan for hammers. Okay, now we got hammers. Okay, so let's go back to ETFs and see if we got any ETF with hammers. And the ones that we have with hammers are ARC, the Vanguard, and XME. So XME, metals and mining, that's a decently liquid ETF. Okay, that's a decently liquid ETF. Now notice it doesn't show IWM. Okay, and the reason why it doesn't show is because that pattern is not seen as a hammer either, because a hammer means that you will not have that. Let me make this larger. Okay, so that top wick on the top, okay, that basically kills that formation by being called a hammer. Okay, and that's why it's not showing up on the list. Okay, so again, I'm just gonna persist a bit more to see if we can get the IWM, so you know better what it was. Okay, so bullish engulfing, that's the one is happening this week, but you should not have that result until next week. Actually, it does show. That is surprising to me. Let me see. Okay. So then, yeah. So then I was not aware of this, guys. Sorry about that. Because the way we had the scanner set up is that it would only execute at the end of the day. But I believe, because so many details that we've discussed with our development team, that right now I got confused for a moment. I believe that what we said is that on the daily time frame it would wait until the close, but on the weekly time frame, because a week lasts a lot, so during the week it will give you the signals during the week. Okay, so if you scan for bullish engulfing, which is what's happening, so then yes, we do get IWM. Okay, so let's go with that. And sorry if I confused you. This is not a type of filter I normally do. But indeed, it's a valid way to approach it, Christian, especially when looking for long-term moves. So looking at those bullish candlestick patterns, it's relevant. And I would say it's relevant beyond the fact that candlestick patterns have a meaning, which statistically speaking could be impactful. That market analysts know a lot about that. But beyond that, what's very attractive to me about doing this type of scanner is the fact that these type of patterns are being watched by many people, or many market analysts will talk about it at the end of the week. And therefore, it acts as a kind of like a signal for many people to get in the market after you get in the market. Okay, so if we find an opportunity to get in now ourselves, and many people get in next week because now the pattern is confirmed, and now blah blah blah, and now many market analysts are talking about it, many people become aware there is a bullish candlestick pattern on the IWM, so now many more people may get in. And again, it's the same concept as the climate, if you think about it, where the climate, trading in the direction of the climate, is basically increasing the odds of having more people buy after you bought, or having more people sell after you sold. So these candlestick patterns have a little bit of that effect, and that's a nice to have. Okay, that's a very nice to have, especially when you position yourself for an intraday move, a long-term move, where it's not going to be just a little vibration intraday, but it's something so much more serious. Okay, so good one. Okay, so first part of the scanner. Okay, so now let me go back to what I was doing if I re-add all of this. So then it's not gonna show. And if I go back to the auto climate, so let's see out of all those ETFs, which ones are in sensible mode. So notice that none of them are in sensible mode. So if I look at IWM and I look at the weekly time frame, probably, yeah, it's still red. Okay, it's still red. Okay, so you gotta be careful, okay, because you are getting into a market where, thanks to a candlestick pattern, you have odds in your favor, or that candlestick pattern is telling you something which is relevant. You also had an Elliott wave turning point show up there, which is a long-term Elliott wave turning point. So all of this is telling you a lot about potentially going up all the way to the orange box, around 250 up there. So that's very powerful. But at the same time, technically speaking, you are still in a down climate. Okay, now fair enough. The climate is supposed to last 3 candles. It's been already happening for 4 weeks, meaning that this climate, statistically speaking, should change. But the furthest away that climate went was 125, where 2 standard deviation is 2. So in other words, that climate is lasting for too long, but that climate is nothing that violent to the downside. And therefore, you could certainly see that climate, to continue for a bit more, or get to see some sideways market until much, much later. This is going to change. Okay, so you gotta be careful. So now, in a perfect world, you would look for confirmed climates to the upside. If you don't have confirmed climates to the downside, then you would sorry, let me rephrase that. If you don't have confirmed climates to the upside, then the next alternative I would like to see is to have confirmed climates to the downside, which are late. Okay, late. And when I scan for that, okay, I get this guy. Okay, this guy is like this. Okay, so if I check this particular guy, so notice how the climate has supposed to be 2, it's been 5. 5 is more than double of 2. Okay, that's what late means. That's what late means. IWM is not late, it's hopeful. Okay, hopeful means, again, if I reload, is it sensible? Yes, it's still sensible actually. Yeah, still sensible, because that number 3 is probably 3 point something, so there is a decimal place. So in other words, IWM, it's in a down climate, which is technically reaching its end, statistically speaking, but it's not as it's not a climate which is that exhausted, such as cases like if you had selected late or if you had selected hopeful. So in other words, I am very keen to put together a long position to take advantage of a potential move with IWM, changing climate, going back up, take advantage of that Elliott wave turning point, take advantage of that candlestick bullish pattern. I'm more than happy to do that, but I'm going to do it with a very skeptical mindset, because the climate is down and there are no signs that show that the end is happening soon. I mean, technically speaking, this week should be the last, because it's candle number 4. But at the same time, the max distance doesn't show any exhaustion. And at the same time, we've seen many times that the climate will last more than this theoretical duration, based on statistics, right? So I want to plan this trade in a way where if I'm going to profit, I'm ready to go. But I also want to plan this trade in a way where if it's going to fall more, I'm not going to get hurt, or minimize minimize my pain. How am I going to do that? Well, in cases like that, my favorite approach would be something you have seen me do before, which is to buy a call. But for me to buy this call, to go ahead and sell 2 puts and sell 2 puts and buy 2 puts below. Okay. In other words, set up 2 bull put spreads at a lower price point. That will create a credit that will help me to buy for the call. So then if that market was going to fall, even if it falls very, very deep, the most I will lose is the distance between those puts times 2. But if it rallies, then the puts are making money and the call is making money. So everything is profiting for me, but I'm giving myself this buffer that allows me to be wrong, the distance between the call and the puts. Basically, I can have that IWM to go down, go back up, and as it was going down, my P&L would show negative, but to be honest, it's a temporary value The only time the P&L truly becomes negative is if it falls below the bottom put, because now that bottom put is going to be assigned, and you have the puts to protect below. But the moment you get to assignment, then time decay doesn't help anymore, and that's when you find the real pain. Okay, so I want to give myself that cushion that allows me to be wrong by a certain amount. That's why I want to sell puts below price. But then I want to get positive deltas because I am actually bullish on this trade based on what we discussed. And therefore, I'm going to buy a call in exchange for the premium received. Because I want the call to be relatively close, so I get decent deltas, then what I'm going to have to do is I'm going to have to sell two puts and buy two puts, because if I was to sell one put only, probably that would not pay me enough. Or if I was to bring the puts closer to price, then yes. But then the problem is I have immediate risk if I do that. And I don't want to have immediate risk because the climate is down while I'm bullish. The climate is still down. Okay, so I want to give myself that opportunity to, absorb a certain degree of being wrong before I get really, really hurt. Okay. Got you, Christian. Well, actually, I don't see any problem of going on with IWM with everything that we've said. Again, you have the Elliott wave turning point. On the daily time frame, the climate already changed to blue. All of those things, right? So I actually don't see any problem. I'm just saying, let's be careful. Even the implied volatility of the call versus the puts is greater on the daily time frame, right? So all of this, to me, it's okay. It's worth it for us to plan on a trade. Again, we're talking about a long-term investment, okay? And not a problem, okay? Okay, so let's go for it. Okay, let's plan on this long-term investment. Okay, so notice I'm using a weekly time frame here. Okay, I'm using a weekly time frame. Where should I sell puts to pay for the call? Well, the place where I should sell puts to pay for the call should be, okay, I just inserted the pivot indicator as you saw. Why? So I can input the speed bumps. Okay, so notice that around this area, we get a speed bump. Okay, that's coming from the weekly time frame. Now, if I look at daily, okay, the UFOs available are below at 185. If I look at today, and that's 51% probability. If I look at today, we actually have UFOs at 201, and that's 62% probability. So I'm very happy about that, actually. And if I look at 3-day, it's below. Okay, so the 2-day setup is the setup I like the best to identify my on-field orders that are lining up with the speed bump that I plotted out of the weekly time frame, because I'm planning the trade out of the weekly time frame, because it's the weekly Elliott wave turning point, is the weekly candlestick formation, is the weekly everything, isn't it? So I got that, and therefore the puts I would be planning on selling. Okay, let me make a note. Okay, I am planning to sell puts around 201 because we saw green UFOs, and that was the 2-day time frame. Okay, so that's what I'm thinking. Okay, now while I keep my note here so I don't forget, the next question is how far I believe that market is gonna go. Okay, well, in this case, Elliott wave can be very, very handy. So the final target for Elliott wave is up here. Is also very handy because obviously this is all-time high, so it's not like we can load UFOs or anything like that. That price point got nothing. We can certainly also plot the speed bumps, okay, and the speed bumps are falling into that area. So I think that I guess it makes sense if we select 258 as the target. So that way we are lining up ourselves with an Elliott wave target together with a speed bump target, and so on. So that, I believe, it's quite logical. And if we were to think about how long it's going to take for us to get there, okay, at 258, I'm going to have to do this. Here we go. So if I come here at 258 and I write, why is not allowing me? I'm not sure why. Okay, maybe here. Yes, here we go. Yeah, because I had the mouse on top of the bottom speed bump, so the platform thought I was editing the speed bump if I right click. So now I'm sending this to the strategy builder with a target of 258. And the reason why I'm doing that is so I can estimate my time to target. So the time to target would be May 9, 2022. So we are planning a trade using May. Okay. So again, this is for some investors, a five or 6 months trade is not that long as an investment. But indeed is not as short as the type of trades we normally plan, isn't it? So this is and again, it's because we are planning all of this on the weekly time frame. So we are talking about May. Okay, we're talking about May. So let me take a look at the option chain on IWM, and let's take a look at May and beyond. So if we look at May 2022, then we have June. Then that June 30 is a weekly expression date, so I'll skip it. Then we got August and September. Okay, so I'm just checking a few strikes so I can look at liquidities and things of that sort. Because when we go out in time, often liquidity, gets bad, even though IWM is quite liquid. So not too bad. Actually, the August is actually worse than the September from a liquidity point of view. And the June is actually pretty cool. And May is very good. So yeah, so June is 18 cents of spread. August got like 50 plus cents, and September got around 50 plus cents as well. So again, it's looking to me that June is the ideal candidate. It's 177 days to expiration. We are keeping the spreads quite narrow, and in that sense, I'm pretty okay. But I am also curious to know more about the volatility smile. So I'm gonna load June. I'm gonna load August, and I'm gonna load September, and I want to see the calls and the puts. And did I? Okay, now, so, and this one, here we go. Perfect. Okay, so notice what we can see here. Think about what we were said, right? We're going to be selling options around 201, which 201 is here. So we're going to be selling puts there. It's great because volatility, we have a beautiful smile in that sense. So volatility, it's likely going to pay us very well. Look, those values are pretty high, 20+% volatility. And then we're going to buy a call above, and notice how all the calls, whatever call we're going to buy, is going to be lower volatility. So the calls we're going to buy are going to be cheaper compared to the puts. So that's great. This is a great shape for a volatility smile that has a skew, and that is helping us. But at the same time, if you look at it carefully, if I am not mistaken, what I notice is that the gray has a steeper angle, meaning that the calls, are more low here and the puts are higher there, right? So, the call, to be honest, the call is the gray line below, which is the solid line. And let me draw this properly. So this is the dotted line is the put, where the solid call is the call, the solid line is the call. And notice how, again, instead of moving with that type of an angle, it's moving with that type of an angle. You see that? So in other words, it seems that the puts are more expensive than the calls compared to the other expiration date. So June 17 not only has less slippage, but it seems that we're going to get paid a bit more on the puts, and we're going to have to pay a bit less on the calls. And that's going to help us to, scratch, a little bit better prices in the entry for the trade. And in this case, that means less risk or more delta. So I just made up my mind here after looking at this, and we're not going to use May or August or September. We're going to use June. That's the expiration date that we're going to use. Could you please, guys, confirm that you followed the rationale of what I just explained here? on how I put this together? Can you guys please confirm that? How I ended up concluding June is the one? While you're responding, and even if it's clear for you guys, I'd appreciate a quick okay on the chat box. But basically, the way I've done it, it's first I use the strategy builder to calculate my time to target, which was May. So I know I need to go May and beyond. And then I look at May and beyond, which is June, August, and September. And when I looked at those, then I looked at the slippage that I was going to get, and then I looked at the implied volatility. Okay. And I saw that the implied volatility of June had a steeper angle compared to August and September. So it was a bit fast, Christian, so no worries. I'm going to show it again. So if we look at June in gray color, okay. Okay, just give me 1 second. I'm just going to add a few strikes. Okay, so we looked at June on gray color, and then yes, I'm just waiting for the market data to be downloaded. Here we go, and then we are looking at August in red color. Okay, and as you can see, the gray line is falling, faster compared to the red line, which is a bit flatter. Both have a good angle, meaning that the puts are going to be the puts. I'm pointing at the left side because I'm going to be selling puts at a lower price, 201, right? And the calls, I'm going to buy them at a higher price. So the calls are going to be less volatility and therefore cheaper. And the puts, because they are lower price, are going to be at a higher volatility level. Therefore, they're going to be more expensive, which is exactly what I want, because I'm going to be selling expensive puts to buy cheaper calls. But when it comes to expensive puts versus cheaper calls, I guess you are with me that with the gray line, the puts are more expensive compared to the calls, which are cheaper. Okay, I guess this is more clearly seen. Okay, so if I do puts and call both, so the dotted line, okay, the dotted line is the put, and the solid line is the call. So I'm going to be buying calls at 23 vol, and I'm going to be selling puts at 26, 27 vol. That's what I'm going to be doing, and I can be more efficient with the June expiration to do that versus the August expiration in red color. I can be more efficient. Is that understood now, Christian? That I'm going to be more efficient by using June instead of August? And yeah, so let me know if this time is all clear. And everyone, guys, and please do not be shy. If you need me to repeat, if you need me to go back to the beginning of the process, I'm happy to do it. I want you to understand this, putting on the side that this may be a good trade to take as well. Of course, that's for you to decide, but you cannot decide unless you understand. So make sure you ask questions if you have. And if you don't, just tell me, all good. So that way, I'll be the one having the question, which is, hey, how is it going? You guys tell me, all good or not. Yes, easier to read it because on the second round, Christian, thanks for that, I added 2 expiration days versus 3, and therefore you had less lines, so it's less confusing. But I had to add 3 lines at the beginning, so I get to see those 3 expiration dates, right? But again, when you get used to it, when you know what you're looking for, basically, your eye will get trained very quickly because you know what you're looking for, okay? And now you know what I was looking for, which is having puts that are more expensive than the calls, so I can buy cheaper calls and get paid more from the puts. So my calls can be closer to price, so I get an overall greater delta amount. Wonderful. Thank you, Joanne. Good to see you, Joanne. So anyway, so let's continue. So we are going to be building a position here. Okay, so I did the spread. We're going to be building this position using June 17. The beginning part of the trade is going to be to sell the 201. Okay, if you need me to repeat why 201, tell me. More than happy to repeat it. Okay, but we're going to be selling the 201 put, okay, as we have analyzed before. And let me load all strikes for that expiration date, June 17. Okay, so the 201 put, okay, is going to pay us anywhere between 9 and 8. Okay, so the midpoint is 8.95. This is what we're going to get. And of course, then I need to buy an option again, right? So what I'm going to do is buy an option below 201, which the next one in line to minimize my risk, okay, to make it as small as possible, is the 200. Okay, so sell the 201 and buy the 200. Okay, if I do that, so I am creating a net credit of 25. Okay, that's a net credit. So I sell one at 8.95, I buy one at 8.68, I have a net credit of 25. If I do it twice, that's going to be a credit of 50 cents. Okay, and if I do that, 50 cents, that's not going to be good. You will see why in a moment. We're going to adjust it, okay, to make it better. But if I do 50 cents, so that means that I could buy the 285 call at 35 cents. Okay, or anyway, 42, 48. So if I buy the 285 call, okay, so options leg, buy the 285 call, okay, and by the way, the put side is 2, okay, so sell 2 of the 201 put and buy 2 of the 200, you create a credit of 50 cents that you use to buy 1 of the 285 call. Okay, so that works to make the trade free of cost, and therefore your risk will be $200, which is the distance between 201 and 200 times 2. So that will work, but it's not going to work too well in the sense that we're going to get very little deltas because 285 is a strike which is very far away. Okay, it's very, very far away. It's a very far away strike. So this trade is going to profit nothing, right? Unless IWM rallies to the moon. So we're going to have to tweak it. But before I tweak it, I want to show you how this trade would create a net credit of 8 cents. Okay, 8 cents. And then you would have a delta of 5. Okay, so if I graph it, okay, so if I graph it, you will see how, weak it is. So if the stock, stays between, 285 and 201, then you're going to make $6, which is the net credit collected. Now, if the stock really picks up speed and let's say the stock goes to 290, now you're going to make, on expiration, $900. So that's great. But wait a minute, our target was 258. So our target is actually here. So that's not going to pay us well. And the reason why is because we are starting with 5 delta only. And the reason why is because we are buying a call which is way too far. How can I do it to buy a call which is closer? Well, I don't have too many choices. So the problem with selling the 201 and the 200, okay, and I do 2, is that the net credit collected is 52 cents. And when you look at the option chain, if I want to have an option with more delta, okay, let's say the 250 option, that option costs $3 plus. So how can I create a credit of $3 instead of a credit of 49 cents? Well, my friends, there is no magic, but taking more risk. Okay, so if I was to utilize, let's say 201, 197, for example, and I click OK. So now I am creating a credit of $1.96. Okay, that's the credit I'm creating now, $1.96. If I want more credit, I need to lower the strikes a bit more. And now I got a credit of 284. Okay, so for example, if I do 284, okay, so what can I buy with 284? With 284, I could buy the 253. Okay, I could buy the 253. So if I buy the 253 call, one of the 253. I think I said 283. Sorry if I said that. I meant 253 call. Okay, if I do that, so notice how I end up with a 009. okay, 009, which basically it's a credit of $9, $10. But now notice how my delta now, it's a delta of 26. Okay, so I got a much better delta. Why? Because the call I purchased is closer to price. Instead of buying a call which is all the way, out of the money all the way. So that call is still out of the money, but much less. And therefore I got more delta. And then if the stock moves, I'm gonna start being paid better, more efficiently. Okay. Now the price to pay for that is that the distance between the call I sold and the call I bought is $6. So my risk is actually 600 times 2, which is $1,200. So this trade has a way greater risk, okay, way greater risk, given the fact that the distance between strikes is greater. And yes, now if you get to your target, okay, so if you get to your 258, so now you're gonna make $500. If you get there today, you're gonna make $746, $743 if you get there on the very expiration date. Sorry, if I said that backwards. If you get there immediately, you make 743. If you get there on the expiration, you're gonna make 500 because there is a time decay that impact the call that you bought, of course. Okay, so I said it backwards. So anyway, this trade may work, okay, in that sense. But now this is a trade where you need to be very, 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 very positive that you're gonna reach the target, because notice that you are assuming a risk of $1,200 in exchange to make 500. So from a reward to risk ratio point of view, this is not helping you. The reason why this is helping you is that if the stock, which is currently trading at 219.69, drops all the way to 201, okay, well, you remain in that position where your P&L is going to be flat. Temporarily, you're going to see a little bit of a drop in your P&L. But as time decay passes, as you approach expiration, the P&L will go back to be close to flat, which is those 6 cents of credit you collected, which is $6. So you could afford to be wrong from 219 to 201 if you do the math. Okay, if you do the math from 219 to 201, so that is $18 out of a $219 stock. So basically you can absorb 8% move against you and it's not hurting you. So that as an investor, and keeping in mind what I said about the fact that the climate is against us, while you have a bullish sentiment building up on the stock and you have the bullish candlestick and the Elliott wave, while you have all of those things, the climate is down, and therefore you have this peace of mind that you have 8% move against you that is not going to hurt you. Now, if it's beyond that, of course, now you can lose up to 1,200. So, and what's the issue here? The issue is that having done this trade a few days ago would have been great and would have showed way, way, way better. Okay? Today, the way it's looking like, I'm not going to put this trade in the account. I would not suggest to go for it either. And the reason why is because we don't have enough implied volatility. The implied volatility has cooled down. Options have become cheaper because the S&P has been moving higher and everything else, relaxes. But if we have done that a few days ago, you would have had so much more implied volatility on the put side, which you saw it's currently 27 or something like that. It would have been so much more. Take a look at this. If I go for individual legs, so you can see how the put I'm selling has an implied volatility of 28. The put I'm buying has 29, and the call I'm buying has 20. Okay, so what if instead of 28 a few days ago you got 35? Okay, what if you got 35? What if you got this one would be, let's say, 37, and that one, let's say that one was 24, something like that. That would have been the pattern. That this is a guess, obviously, but this is what I would assume. So notice what will happen now. Now, next thing you know, the moment the stock rallies, the profitability changes completely. Now notice the profit that you will have if you were to reach the target. Okay, and that's because the volatility conditions were different a few days ago. Okay, so all of those things are to be kept in mind. It's like everything in life. We know trading is no different. It's all about timing, and timing in this case is not only about the candlesticks on the chart, but also the implied volatility on the options. So now this same exercise I have done, Christian, if you are looking for some sort of a long-term opportunity to go long and so on, you could certainly go ahead and repeat that exercise with the other ETFs that showed up in the list. And you may find an opportunity which is valid that gives you the option, the possibility to sell puts, which are much closer than the calls, at a net cost of zero with a much greater delta. And now the trade would be way, way, way more worth it. With IWM, this is not available today, and therefore the trade is a bit, disappointing from that point of view. While the setup is fine, it's a bit disappointing. So, what I would do in a case like that, so let's say you want to use IWM and that's what you want to do. So then what I would do is use patience. Don't do it now. Okay, don't do it now. And what I would do is wait until on the weekly time frame that climate changes to blue. Okay, that climate changes to blue, because if that climate changes to blue, now instead of having to sell puts which are located at 201, you can start selling puts around, for example, that green UFO located at 217, right? And if you sell puts which are way higher at 217, you're gonna get so much more premium. So now it's so easy to get calls which are closer to price, and you're gonna get a fantastic delta. Still a little bit of a buffer that allows you to be wrong, much less, but you should be okay with much less if the climate has changed to blue. I would not be okay with less if the climate is still red. Is that making sense? So hopefully, what we discussed today is useful. We don't often talk about putting in place long-term opportunities, because often, I'm more focused on spicing it up a bit, in the sense that, I look for examples and opportunities that could be subject of discussions, and, talk about, interesting options, tweaks, and skills that can make you a better options trader if you are active. But certainly, the long-term trading of options is fantastic, and today's application is about that. So hopefully that was a good exercise. Thanks for that, Christian. Yes, correct. Ghosty can be good if you have a cushion if trade against you. You will normally have that when volatility is higher. If volatility is lower, then you get paid too little, so you don't have the cushion. Okay. Cool, my friends, wonderful. So we are done for today's session. I'll see you tomorrow, same place, same time. Keep up the good work. Tomorrow I will say Merry Christmas to everyone, because it's going to be the last session before Santa Claus come. But in case some of you cannot make it tomorrow, which I would obviously understand, especially at this time of the year, so I'll say Merry Christmas and Happy New Year, and all those celebrations. If you're in Asia, also would like to wish you very, very happy and prosperous winter solstice as well. Hopefully you had beautiful rice dumplings. Don't miss that, which are delicious. In my case, I got both, the rice dumplings into all the good foods that we're going to have as well during the Christmas season. So you guys take care, and I see you tomorrow again, same place and time. Bye-bye. See you soon. Bye-bye.